I've been operating in commercial real estate all of my life for some 40 years in practice, and I'm still learning. But one thing I learned at a very early age was the fact that property has a distinctive characteristic that separates it from all other asset classes, and that is property is totally unique. If a salesman tells you the property he's selling you is unique, it's not hyperbole, it's the fact. Every property has a different location, every property has a different building. And because of this uniqueness of the asset, each of the assets, it's evolved a whole profession to come to terms to valuing them. Unlike 100 ANZ shares, for example, they're worth the same in Melbourne as they are in Sydney at any particular point, and they're being valued daily by the minute by the market. Likewise, an ounce of gold is worth the same in Melbourne as it is in Moscow. However, property, each being unique, has different values. The other distinguishing characteristic of property as an asset class is that it has very high transaction costs, typically 7% of the value of the asset. Further, it's a protracted process to get out of or to liquidate a property asset. It typically takes you 3 to 6 months. So these two features, mainly high transaction costs and long time to get out of the asset, means that you have to consider property as a long-term asset, and that is, say, 5 to 7 years. You can't afford to be getting in and getting out of it as you might a share portfolio. So that means you've got to be very, very careful about your commitment to a particular property because it's an expensive and protracted exit. So therefore, before you invest, I'm encouraging you to exercise 3 habits, if you like. Firstly, you must fully research your market. Secondly, you must be very disciplined about the criteria you are seeking for the property you're seeking to purchase. And finally, you've got to give yourself time. Give yourself 6 to 12 months if necessary. Be patient. Be patient with your selection of property, because if you're going to be committed for up to 10 years, maybe 15 years, spending 6 to 12 months searching to make sure you get the right property is really not going to be a disadvantage. Commercial property we broadly define into 5 categories. We have retail, office, industrial, hospitality and specialised properties. And each of these properties we further define into smaller categories or subcategories. With retail, for example, we have the small shop, we have the convenience centre, then the neighbourhood centre, and then the regional centre, and then we have the showrooms, factory outlets and homemaker centres. And then moving on to industrial, we have the strata industrial and the freestanding industrial, likewise with office, strata and standalone. Moving into hospitality, we have the cafe restaurants, we have the hotels, motels, fast food outlets, and moving finally into the specialised category, we have service stations, car wash, aged care and childcare centres. And we'll talk more about each of these segments and what we like and dislike in those later on. But more importantly, I want to talk now about our 4Q rule. Quality lease, quality tenant, quality building, quality location. Remember those 4 rules and you won't go far wrong. Now, getting down to firstly for the quality lease, what are you looking for? You're looking for a relatively long lease. A 3-year lease is a little bit short, better 5 to 10 years. You want to get options in the lease because that gives the tenant encouragement that he can stay on. You want to make sure it's enforceable, so make sure you get your solicitor to check it out and make sure all the clauses can be enforced. You want to have annual rental adjustments. And finally, you want to have a lease that's moulded or tailored to the type of property. A retail lease will be different to an industrial lease to an office lease if it's been properly drafted. So that's a quality lease. Secondly, we have a quality tenant. We want to make sure the tenant is in a viable business and he's doing well and he's got good growth prospects and he's not going to be out of business in the term of the lease. And finally, the business trend. You need to make sure that the trends for his business is strong and going in the right direction, and he's going to be profitable, and hopefully he's been established for a number of years. So quality lease, quality tenant, quality building. Now this varies, of course, the criteria for this vary according to the type of property that you're leasing, but say with an industrial building, you want to make sure there are proper turning circles. There's B-double access for the larger properties. There's plenty of roller shutter access. There's good floor loadings, column free, minimum height of, say, 12 metres for an industrial building. Good car parking, good light and good condition for the building itself. Good quality maintenance. And then finally, we have quality location. You want to make sure that if it's an industrial property again, it's close to freeways, it's close to railheads ideally, It's in a central location, it's not out in the boondocks somewhere. It's got high visibility and it's got amenity. But again, the locational criteria for the various types of property will vary. Retail obviously is going to be different to industrial, to hospitality. So look at the segment you're going for when you talk about location and make sure those criteria are met. So what's the outlook for commercial property looking forward? There are some sectors we prefer over others, and those we prefer least include retail and hospitality. Retail, firstly, there's a lot of competition in retail at the moment. There's majors entering the market, the Costcos, the Zara, the Aldis, competing for margins and competing for outlets. On top of that, Australia is pretty well supplied with retail's floor space if we look at the number of square metres per head of population. Further, there's very strong price competition amongst retailers. We're in permanent sale mode these days in Australia. We don't wait for the Christmas and half-year sales anymore. It's happening all the time, so margins are being cut. And further, with the increasing dominance of the majors, we are getting price makers rather than price takers in terms of rental and lease conditions. So add to that also the higher interest rates, strategy, or the higher interest rate environment we're now entering. There's a lot less discretionary income for spending. So overall, whilst we think retail long term is going to survive, we don't think it's a segment you want to be in at this time. Likewise, we can't get very excited about hospitality at the moment. Hospitality is a very cyclical segment, and it tends to be a pretty wild ride. With the higher Aussie dollar, we're getting local tourists escaping overseas and overseas tourists not coming to Australia in the numbers that we saw in recent years. Further, it's heavily dependent on the discretionary dollar, which is being squeezed with higher interest rates and a tightening segment in that market. Too many people with hospitality get carried away with the emotional side. This is where you really do need to exercise discipline. So many people get hooked into vineyards, restaurants, hotels because of the romance of the ownership. But it's a very, very dangerous sector. So here you have to be particularly disciplined if you're contemplating getting into that sector, to make sure you look at the logic and don't get overwhelmed by the emotion. So we're not so keen on retail and hospitality. We do like office, industrial and some of the specialised property investments that are available. With office, we do like office. It's heading towards undersupply. We have a healthy growing economy. Very little new construction is underway, and there is a competition for sites for office buildings for residential medium density developments, and the residential's winning. The banks aren't funding developments, and we also see rentals for office investments will be rising up to 25% over the next 3 years. So we like office. Likewise, for similar reasons, we like industrial. It's a strong economy, there's very little new construction, we see rents rising. However, if you are looking at industrial, I would prefer to be looking at warehouses rather than factories. Given the long-term decline of manufacturing in Australia, go for a warehouse over a factory, but if it's a strong business, factories are fine. In the specialised property investment categories, we like service stations and we like childcare centres. Service stations are a little bit like small supermarkets. They've got strong major tenants, oil companies typically. They've got long leases, high land content, prominent locations, and no management hassles. You get a cheque in the mail at the end of the month. And further, it's an essential service. However, when you're buying a service station, be careful to check that the tanks are double fiberglass, the pipes and lines are fiberglass, and they are monitored. And there's a clause in the lease to say that the operator or the lessee will rectify any degradation or environmental problems brought about by their tenancy. Likewise, childcare centres, long leases. There's growing demand, it's an essential service, there are some strong chain operators operating them, and it's subsidised by the government. So of the specialised property investments, we do like childcare centres and service stations. So we see the outlook for selected commercial property investment looking forward as quite strong. You can get yields of between 8 to 9.5% income yields, that's net yields, and when you add that to the typical capital gain or capital growth yields you can get on property, that's a grossed up yield of between 11 to 14%. Pretty attractive, particularly when you compare it to residential investments where your net yield might only be 3.5 to 4% if you're lucky. And further, there's a joy of ownership to owning commercial property, and also you're being bricks and mortar, your assets aren't going to evaporate in front of your eyes, as often happens with the share market, for example. So finally, just remember to exercise discipline. Be disciplined with the criteria you have applied to your investment. Be patient. It's a long-term investment. If you're going to buy, you're going to be there for a long time. And research your market thoroughly.